All right, we're live. I think that's how we start every live. You got James Hang with James Wilson here with Full Capital. And what are we talking about today, James?
Today, we're going to be going over the lessons learned from the bridge loan foreclosure heard around the multifamily world.
All right, so we've heard about some recent foreclosures out in the market, and I was interviewing JC with Velo yesterday, and he mentioned another deal over in San Fran. I think it was Veritas or something. Pretty big group out of San Fran.
I saw that this morning. $1 billion loan foreclosure.
Yeah, so so this is sort of maybe the beginning, some of these deals. So this is what we're going to be talking about. I mean, this is sort of the headline. The apartment owner who lost 3,200 units. So just to be clear, so we can say this right from the beginning, we did not do these loans. So just to be clear, we didn't do any of these loans, but we're going to go through just sort of what we've seen, what we've heard, and just sort of piece together. It's a little bit of a mystery, but we'll try to give as much insight as possible. And then maybe for the people who are on live, maybe drop in the chat sort of where you're coming in from. And maybe we get some people from Houston to add some color on some of these properties. That'd be awesome. But yeah, drop in the chat sort of where you're dialing in from. And all right, so let's flip over. All right, so this idea actually came from a comment on a YouTube video, and basically this person was like, ideas for next video, detail the reasons that led to the foreclosure of the operators in Houston's lessons learned. So and then her second part of the question, which we might tackle towards the end, is interested to see how people can capitalize on these deals, right? So whether they can't refi or they've just got to sell, and so having some distress. So we'll touch on that as well. So any ideas, we are definitely open to them. Just comment on the video and we will jump into it. So all right, so this was a slide, I think it was probably like a month ago, sort of beginning of April that this happened. And we got first of all, it showed up on Twitter. Twitter, I guess, is the first news source, the fastest news source. So somebody posted up on Twitter, and then it caught like fire on social. So
I think it had hundreds of thousands, if not 1 million views on Twitter on one post.
Yeah, so appreciate everyone jumping on. We got Adam coming in. We got some people from Chicago, and then we got some people from Dallas. You got some Fort Worth. All right, nice.
Worth.
Pennsylvania. We got California. Nice. Thanks a lot, Arthur, for coming in. And
thanks for subscribing.
Yeah, and then so is that the same person who
Yes, it is.
Okay, all right. So
Santa Ana, California.
So here you are. This was your comment. So we are real. So a lot of times people are like, if I make a comment, is anyone going to look at it? Yes. So you made the slide. So thank you very much from Santa Ana. And then we got some people from Seattle and New York.
We'll also respond to all your questions too.
We're actually real people. So appreciate everyone jumping in, and we will. All right, so let's jump in. So I guess what qualifies us to do this presentation is in 2022 we did 1.2 billion in multifamily loans, and then in the first quarter we did close to 160 million, even though the market was a little bit slower. My background, I spent 10 years at GE Capital underwriting 750 million in commercial properties. So that's all types of properties. And then the last 7-8 years, I've done close to 1.5 billion in multifamily loans, and then also invested in close to 40 properties now across Texas, DFW, Austin, San Antonio, and Houston. And then our big show coming up in October, you can actually see us in person. Live at the Old Capital Conference. This is October 4th and 5th. That'll be probably 400 or 500 of our closest friends at that event. So I'm going to open it up. So we'll jump back and forth between this slide. But so if for the people who are on live, what I would like to see is what are some of the lessons learned that maybe if you followed this, you can't see my 10 lessons learned on the left hand side because it's too small. But what are some lessons learned? Maybe put in the chat. Um, and yes, we did take up your ideas. So lessons learned from this. Coming from, and then we got Malay from LA. And so maybe put in the chat some lessons learned that you guys had, and we'll fill it in right here as we go through this. And all right.
Yeah, I guess I can just kick it off with the first lesson. Well,
All right. Yeah.
we'll
Yeah.
jump in.
Yeah.
But
Jump in with your lesson. All right.
I think one of the first obvious ones is having an interest rate cap.
Okay.
It seems pretty intuitive now to get an interest rate cap on your bridge loan, but at the time, people were thinking that the interest rate cap was not worth it. They didn't want to pay the 50, 70,000. Maybe that one was a little bit higher, 150,000, 200,000. But that interest rate cap, basically 100x from that point once interest rates started to rise. So if you didn't buy the cap, your loan payment went through the roof.
Yeah. So here's the example. So the exact loan amount, it was 4 different loans, and it was approximately $230 million. And when they bought these properties, the interest rate at the time was, let's say, SOFR plus 3%, and SOFR was 0. So you can see SOFR right here, sort of all throughout 2021. And then the Fed really didn't start hiking until March of 22. And so when they bought these properties, it was from sort of middle of 21 to beginning of 22. And the interest rate was 3%. So it was SOFR plus 3. So the interest was 6.9 million. And then over time, the Fed raised all the way up to 5%. So now it's SOFR is at 5%, your spread's 3%. So can you imagine your interest payment going from $7 million to $18 million? Just the interest payment. And, most of these deals were bought at a 5% cap. I just gave 5%. Could have been a little bit lower. Could have been a little bit higher. But, on average, let's say 5% is where most of these deals traded. So you're at a $15 million NOI. So you have a hole. This is every year. You have a hole of $3.4 million in deficit just from the interest payment. That's ignoring everything else, ignoring higher taxes, ignoring. And so it's not that people didn't want to buy an interest rate cap. It's just that they didn't necessarily have the money for it. Right. So if you look, so here's Chatham's interest rate calculator right here on the right-hand side. And this is as of today. So I pulled this as of, I think yesterday. So for 115, so Chatham only goes up to 150 million on their interest rate cap calculator. So I had to split it in half here. So for a 3-year cap at about 2% strike, it was, so I'll make this bigger so you guys can see it. So this calculator, all right, so here's Chatham's interest rate calculator. So 115 million, 2% strike, it was $6 million, or 5% of the loan amount. So times that by 2. So it would have been $12 million to buy this interest rate cap. So it's not that people didn't want to buy the cap. It's just that they didn't have the money, really. So
well, at the time, wasn't it a lot cheaper when the interest rates were 0?
Yeah. So let's say, so I think they started raising, the curve started going up sort of in the back half of 22. Mm-hmm. But in 21, yeah, it was cheaper. Right. But there was still an expense to it. And at 200, like their purchase price was 300 million. Their loan was 230,000. So they were raising like $70 million. So let's just say it's half this number, right? So it was going to be 12 right now. Let's say it's 6 million. It's still $6 million they didn't have, right? So when they went out and raised the money, they didn't have it and they didn't buy the cap at that point. But I think from here on out, every syndicator, every investor for the next 20 years, they're going to buy a cap. No matter what the curve says, they're going to buy a cap. So the cap rate, the SOFR curve now looks exactly opposite of this right now. So the SOFR curve right now is basically down and to the right as we speak. So
is that where the phrase "no cap" came from?
no cap. So all right. So lesson 1, floating rate loan. If you put a floating rate loan, you need an interest rate cap. All right, that's lesson 1. All right, let's hit lesson 2 here. And feel free, anybody who's watching live, jump in with any comments or questions as we go through these, and we can answer them as we go along the way. All right, second lesson: bridge loan with high leverage. So this deal on, let's say so what do you think if we did a Fannie Freddie loan buying at a 5% cap and 5% interest rate? What do you think the leverage would have been?
Probably like 60%.
60% leverage, right?
55,
So 60%.
60,
Yeah, so 55, 60% leverage. So that would have meant that you would have had to raise on, so $300 million purchase price at 60%. So your loan would have been $180 million on Fannie and Freddie.
Yeah, so you got to raise 120 million, and then you got to raise any additional money for capex and reserves.
Right. So this bridge loan was done at close to 80% leverage plus the rehab. So you've got 300 million, and then over 230. Let's do the math. 230 over 300. So you're at 77% of the purchase price on that loan. And so not only, so you really don't have that much margin on the deal. So that's probably lesson number 2 is if you do a bridge loan, reduce the okay. So this is you want to try to take this one, James?
Yeah,
So,
I think after a certain amount of loan, that someone's not going to have a $300 million net worth. There's not many people out there that are going to sign on that loan. So I think after a certain amount, maybe like 20, 30 million, they kind of just take a chance on you and sign you up.
yeah. So
what it comes to a certain point where you're not going to be looking for someone with 300 million in net worth or 200 million.
Yeah. So what you have to remember is if you go back to 2021, 2022, these were 4 individual loans, right? So it was, let's say, 80 million on average. Or let me try to do the math real quick. 230 divided by 4, $60 million on average. Okay. So $60 million on average was the loan amount. And so what happens is when you go out to the market and you have a bridge loan that is $60 million and the number of people that are bidding on that deal is a lot, right? So in 2021, you maybe had 25 bridge lenders bidding for that property in terms of giving that loan. And the way that, how do lenders differentiate themselves? They differentiate themselves with leverage. They differentiate themselves with interest rate. And then the thing that you can't see is they differentiate themselves with the underwriting strictness, underwriting criteria that they are willing to accept. And so a lot of times, like on Fannie Freddie loans, the net worth has to equal the loan amount or be greater than the loan amount. But then with bridge loans, it's sort of like the wild, wild west. It's not, there's no minimum. And so if one guy is willing to do it with a $20 million net worth guy on a $60 million loan, then that guy might win the loan. And so that's what happened, is that they were willing to do the loan even though this person didn't have a net worth of $60 million. And so that's why when there's a lot of competition on some of these loans, it's just sort of a race to the bottom in terms of interest rate, in terms of higher leverage, and then in terms of underwriting criteria. All right. So we got bridge loan with high leverage is lesson number 2. Lesson number 3. All right. So this is so we said we allocated 300 million for the purchase price. We have a $230 million loan at 5%. So the gap there in the equity is $70 million. And so, what do you think the allocation between common and pref was here on this deal?
The allocation between, I think pref was what, another 13-14% on top of the already high leverage bridge loan.
Yeah.
Is that what you're
So
talking about?
yeah. So the amount. So when you go out and raise the equity, you have a choice. You can raise common equity, which is going to be, individual LP syndication money, 100,000 a piece money. And then you can raise, or you can just go get a big chunk, one big check from one guy. And the one big chunk from one guy, that person is usually in front of your common equity. And so the 30 million in pref, we're estimating that amount, but that guy has got to eat, right? So he's got to eat the same way that this loan's got to eat. So the $230 million loan at 5%, that's 11.5. That's assuming you had a cap, right? So when they started the process, it was probably around a 5% interest rate. So they were paying that. And then the pref on top of that, $30 million pref at 7% current. So most of the pref, they sit in front of you as the common equty, right?
First class passenger.
First class passenger on the airplane. They get paid. They get the the carts coming down the aisle, and they grab everything out of there. So they're grabbing the 7% current, which is
they get a hot
2.1.
meal.
So you can do pref. And so usually on, let's say, a Freddie Mac loan, the debt service coverage is 125. And then the pref usually can go down to 110. So they can usually do a pref piece behind just a normal Fannie Freddie loan. So even down here on this risk return matrix. And so there was pref equity in front of the common for additional $30 million. So not only did you have to pay the $230 million, I use 5% interest rate on this because that's probably what they modeled in their assumptions, but obviously that went to 8%. And then the $30 million pref at 7% current. So not only did you have the high leverage bridge that was floating, and now you have the pref equity in front of you. All right. Anything else to add on the pref side?
The 7% pref is pretty nice. You can't get that anymore.
Well, yeah. So, I mean, are you saying to invest in the pref?
No, people looking for pref now, it's like they're 12, 13, 14%. So 7% is pretty good rate.
So the 7% current, that is what you pay currently, but then they are going to accrue probably another 7%. So total, it's probably going to be like 14% or 15% or even more, right?
So on a capital event, they're going to collect an extra 6 or 7%.
At a minimum.
Gotcha.
At a minimum. Yeah.
But that's just coming out of cash flow. So
the
current any rise in interest rate, your NOI is barely covering your payments there.
Yeah, so the pref is sort of set when you do the deal, but the this part is floating. So this is assuming you bought a cap, right? So assuming you bought a cap, then this is what it would be. So this would work, right? This structure would work, assuming you bought a cap. So, all right. So let's go to lesson 4 here. Local asset management. So touch on asset management, James.
Yeah, you had the live with JC yesterday, but asset management is different than property management in the fact that asset management, you're kind of just managing the manager, right? You're probably calling in once a week when you first take over to make sure that everything's getting done, tracking your KPIs, making sure that, the stuff that you want to get done is getting done. And then once it's kind of stabilized and you get a good feel, maybe you do like a bi-weekly call or maybe monthly, but see a lot of times people use a bi-weekly asset management call to where you're just checking up, seeing where the leases are at, renewals, what needs to get done. But yeah, that's asset management. And property management is like the boots on the ground. They're in the leasing office. They're outside doing maintenance, making sure everything in the property is taken care of.
Yeah. So you can't really see this snapshot, but he was based in Dallas, and there's nothing wrong with being based in Dallas and buying a deal in Houston. A lot of people do that, but you've got to be there. You got to be on the ground, especially at the beginning, to get these properties to turn around, right? Especially on a bridge loan, you have a timeline, very tight timeline, right? You might have 2 years, you might have 3 years. So you've got to be on the ground there to make sure. And so what we were seeing was that, within a couple months of buying these properties, there was, rats, mold, trash. Timber Ridge Apartments was just one of the properties. But, when you're in the newspaper, 3 months after buying the deal, you want to be in the newspaper for a good reason. Good reason being like, the mayor's there cutting the ribbon, all that type of stuff. Like the mayor, you don't want the mayor to be there saying that these tenants. And so you can Google it up, Timber Ridge Apartments, and it just, they had videos of tenants and, they were not happy with the asset management. So I would say that's number 4.
You need a forward presence at the property to make sure that stuff's getting done that you want to get done. Because if you're absent and you're just on a call, like they might just say, yeah, we're on it, but you show up to the property and it's like, well, I don't think you are on it. Like, what's going on here? They know if people are showing up. If nobody's showing up, they might not show up.
All right. So local asset management's number 4. All right. Number 5, location of the property. So this was one property that was part of the portfolio of 4. So, obviously there's going to be properties in different demographics, different areas, but if you're coming in and doing a bridge loan, you want to make sure that those residents in that pocket can afford the rents that you're going to charge. Right. And so this was, I think, in a 1 mile radius of one of the properties. So the median household income was $33,000. And, usually, you want someone to pay probably about a third of the rent. Right. So this would be like, $800-900 rents that sort of demographic can afford. But then if your plan is to take it to $1,200, $1,300, $1,400, it's going to be pretty hard to change an entire submarket. So number 5, I would say, is location of the property. So a lot of these properties just couldn't, look how many properties are sort of surrounding it, and the income demographics that are surrounding it as well. So anything to add there?
No, I think you pretty much covered it. It's hard to raise rent in the area that's not going to support it.
Right. All right. So number 5, location of the property. Number 6. So this is a big one. This one is the speed of acquisition. And so, so here on the bottom, so these were the 4 properties: Heights at Post Oak, Redford Apartments, Reserve at Westwood, and Timber Ridge. They were all bought between August of 21 and April of 2022. So how many months is that? That's like 8 months, 9 months, right? So 8 to 9 months. Imagine buying 3,200 units in 8 months.
It's a big jump.
It's a huge jump. And so
go big.
Just the speed of acquisition. So I think if you're looking at, a lot of times you'll want your operator to sort of buy the deal, stabilize the deal, refinance the deal, and then move on to the next one. Right. But then because, we're in the mix for 60 days, helping you acquire these properties, helping you get the loan. It is a intense process, right? For 60 days, it's pretty intense, right? It takes a lot of effort, takes a lot of work to, buy a deal. And then once you close on the deal, that's like the beginning, right?
Beginning of the journey.
Beginning of the journey. And so you can't just move on to the next deal, right? So to me, I think it's the speed of acquisition. And this is what's crazy. Do you see on the right side what I put here? So this is off of Twitter or something.
Yeah. So it looks like a little bit of a fiction in Excel. Is that what they call it?
No. Look at the date. So look at the date.
The date. I was looking at the returns.
Yeah. So the date. All right. So imagine August 21 to April 22, you bought 3,200 units. Okay. And then November of 22, do you see how big that property is? 1,600 units in
Yeah.
November of 22 that they are raising for, right? So I just bought 3,200 units, and now in November of 22, which is a pretty choppy time, I'm trying to close a 1,600 unit deal. I mean, so just the speed of acquisitions. I mean, I think there's a smart way to do it, right? So if you're buying, a deal, let's say a quarter or every 6 months that are a little bit more stabilized, that can maybe make sense, especially if you like assigning asset managers, you're on the ground there, and this is like your full-time deal. Um, but if these are heavy value add bridge deals, it's going to be hard to keep up with that speed of acquisition.
Management intensive.
Super management intensive. Okay, so lesson number 6, just the speed of acquisition on these deals. All right, number 7, size of properties. All right, you want to take this one?
Yeah, I think we kind of touched on it in the last one, but the 1,600 units, 800 units, these properties are huge. I mean, just a 100 to 200 unit property, tons of stuff happens on those. It's a lot of work to make sure everything's going smoothly, and then all the tenants have what they need. And just think about how many maintenance repair requests come out of that. And if people aren't getting their stuff fixed, they're not going to be happy. And yeah, it's just the size of the properties is definitely a challenge. You got to have a really good property management, and then you got to have really good asset managers making sure that everything's running smoothly. Otherwise, yeah, if you just keep buying huge deals and not really paying attention, as we've seen, stuff can go south pretty quick.
Yeah, I mean, I think there's definitely economies of scale as you move from single family to multifamily. As you
Mm-hmm.
move from 100 units with one in, one out to 200 units, now you got 2 guys in, 2 guys out. All right, and maybe I would say maybe in that 200 to 300 unit range, it is probably the most ideal investment size, because now you got, let's say, anywhere from 4 to 6 people. You've got a pretty good staff there. Let's say the deal is 200,000 a door in terms of price, so you're raising anywhere from the deal size is anywhere from 40 to 50 million dollars. Like, you're not going crazy, right? Like, some of these deals, like 856 units, let's just say it's, I don't know, 70, let's say 100 a door. That's $85 million just to buy this one property.
Yeah, then
And
economies of scale can work in the opposite favor for you as well. Like it can really, if expenses and as we see interest rates and loan payments, those can just you can't cover those. Unlike a single family, if you miss a loan payment, you got the reserves, right? Some those 100, 200 units, you got reserves. Yeah, you can cover some stuff. Some of these 1,000 unit deals, if there's some issues, that can get away from pretty quick.
yeah, I mean, I'm not saying syndicators shouldn't do 1,000 unit deals, but I guess make sure you have the capital to back these deals, because when there is a hiccup, it's going to be a big number. It's not going to be a small number to get it done. So I guess this one, does it say the price? I guess it said $76 million purchase price on this one over here. So yeah, right around $80 million for these deals that were around 900 units. So all right, so lesson number 7: size of properties. Bigger is not always better. So all right, lesson 8. All right. All right, communication on a monthly basis. So you're an LP in some deals. I'm an LP in some deals. What do you expect in terms of communication from the general partner?
Expect them to tell us what's going on, what they're working on, what challenges they're having. Um, just be open and honest about. I don't like when someone tries to cover over everything. I feel like that happened a lot. Like 21, 22, it was kind of like everything's great. There's no problems ever in multifamily. But I do like when the the communication is these are the challenges that we face. This is what we're working on. Um, and then I like to see the financials. I know not everybody sends out the financials, but I like to see where the NOI is at. I know the cap rates, and I know where the loans are. So I kind of like to see where the deal sits. I'm sure not all the LPs size the deals like I do, but I like to see
No,
the financials.
yeah, I mean, I don't. It takes like literally 30 seconds to take the monthly package that the property management company sends you and send it out to investors and add some comments on a monthly basis. So I think communication is key in terms of not only I want to see the rent roll, I want to see the T12. Those are the main things that I want to see on a monthly basis, and then I want to see the trends that are happening. And then JC made a big point of this yesterday around the budget. Like, all right, what's my variance to the budget? Because if you don't know where you're headed, you have no idea how you're doing,
Yeah,
right? And so I think communication is huge. And then if there's issues, like you should be communicating a lot more than once a month, right? And so on this, on this, I went to the website off of one of the links, and website is down, nothing. So the communication, because I mean, I don't know how many deals this guy was in, but I mean, there's still a lot of deals he's still in, right? And so people are probably like, all right, where's the communication? And your website's down, you're probably not putting out that much communication. So, all right, that was lesson 8 is communication on a monthly basis, because that's sort of a forewarning or for predicting the future here. If you're not communicating, usually silence is not good. I want to know. I think as a general partner, you should be over communicating more
yeah.
so.
Address the problems right up front. Bad news doesn't get better with time.
Yeah, it doesn't age well like the wine, right? So,
No.
all right, lesson number 9. So this is all rumor, speculation, but people are telling us that they were getting distributions in January of this year
Yeah,
on
this
deals.
is probably the most wild part about the
Yeah.
story.
So imagine you're getting distributions in January, and then you get noticed in April. Hey, actually, we got foreclosed. Sorry, guys. And so that's what really goes back to monthly cash flow, comparing it to the pro forma. So this is one of the deals that we pulled up. So I pulled it up just in Yardi, the Redford, and you can pull the occupancy is 69% today, and you can see the trend sort of all right in 2022. So prior to 21 and 22, it was like 75%. So it's not like it was doing great in 19 and 20. But then
Historical occupancy. Yeah.
and then it sort of came up to 90. The property was sold miraculously, and then boom, 70%. So I mean, you can see a drop sometimes in occupancy. You're coming in, you're cleaning out the tenant base maybe, and then it's going to pop back up.
Well,
But
one thing that you shared with me was a chart with all the bridge loan or all the transactions in Houston, and it was kind of like flat, 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 and then the bridge loan money came in, and so all these sellers probably saw an opportunity, got this occupancy up, and they're like, all right, we can offload this for a profit, and they kind of left a lot of people um, at that high price or stuck with those deals.
yeah, I think in Houston it was like maybe they were doing about 2 billion a year in transactions for multifamily. In
Yeah,
19, and then in 2020 it was another 2 billion, and then 2021, boom, 8 billion or something like that. Like it was like a 4x increase from the previous year. And so, the amount of deals that were done on bridge at that time it was just a huge number. And so most of the time, a lot of if you listen to a lot of pitches, most people talk about sort of a break even point. So usually, what's the expense ratio on these properties? Typically, let's say let's call it a C property. What's your expense ratio typically?
I usually see around 55%.
55%, right?
Yeah.
So if you
Yeah,
take
the
50,
the rule is like the 50% rule. It's like half your NOI is expenses, but I probably advise
half your revenue is
or half your
expenses.
revenue, yeah, is
Yeah,
expenses. But I've
yeah,
seen it's more closer to 55%. So I
right.
always get kind of nervous when, or not nervous, but I always kind of look at a pro forma when they're projecting 45%. It's like I don't know if they're gonna get that low.
Right. So let's just yeah. So on this deal, once you probably slip into 75-80% occupancy, that's usually the break even of like you don't really have any money. Like zero NOI. Like you can pay your expenses, you can pay the debt. But once you slip past 70, you're probably gonna have to start feeding this thing. And so imagine um, you're at 70% and then you're still getting distribution. Just didn't make any sense. So um, I would just check in with, like, sometimes general partners are doing distributions
Mhm.
just to raise money for the next deal. Like, it goes back to like JP Conklin's slide when I had him on. He like, everything's fine, no problem here. There's like a
Yeah,
fire around that guy surrounding the whole room. No problem here. Yeah, don't worry about this. So
we got a bunch of new blood in the syndication space, and
yeah.
we're distributing. Going to the next one.
All right, so this is lesson 10. I didn't know what picture to put on this slide. I should have a picture, but I don't. Lesson 10 is, if you receive a capital call less than 1 year into the investment. So a lot of these deals, they were bought in, let's say, beginning of 22, and they were having a capital call, like essentially end of last year. So let's say 6 months into, so you bought the deal in April, and then like October, they're like, hey, we need a capital call. We're like out of money already. So that is lesson 10, is the um, I guess the lesson should be, is raise enough money for reserves. Um, so I'm going to change this slide up a little bit, because I think,
Stress test the deal,
yeah. So I mean,
but nobody really stress tested the interest rate because
oh, you should have, yeah, yeah,
The
yeah.
Fed. I don't think anyone really did though, because the Fed was saying, "Oh, we're not raising interest rates for a long time," and then
In 21,
yeah,
but
and
not
then
in
21.
22. Yeah, 22 was, yeah. They said they were going to raise in 22. So,
There was a rumor, but it was like, they're gonna raise 3 times 25 basis points, and then
yeah.
just started going up.
So I think I'm going to change this one up a little bit. So reserves, let's say on a fixed rate loan, stabilized deal, what do you think you should have in reserve at the property level?
Uh, Probably 250 a unit for
No, not replacement
reserves.
reserves. I'm just
Okay.
saying
Oh,
reserves
just
sort
like a
of
cash
above it.
cushion.
Yeah, like think about it as an emergency fund for the
Probably like
property.
6 months of payments,
6 months of debt payments or
expenses, debt
expenses.
and expenses. Yeah,
Okay, yeah, 6 months is a little heavy. I
maybe
don't
three.
think, yeah, 3 to 6 months of expenses, so sort of operating expenses, and then your debt payment. I think that's a good number. And then, but so that's on a fixed rate loan. What about a floating rate loan, and bridge,
You gotta have a
like sort of
cap.
value add deal? No, assume you buy a cap. Assume you buy a cap at close. How much in reserve should you have?
I think the same, right? Or maybe less because you got all the capex or no more, 6 to 12. Okay,
Opposite. I think you
opposite.
need more, right? Because, all right, so this fixed rate loan, this is going to be, on Fannie Freddie, this is like a 5, 7, 10-year loan, right?
Yeah,
And then you don't really have your hard maturity is pretty far out. And then you have no interest rate risk, right? So on the floating rate loan bridge value add deal, you've got, I would say 6 to 12 months of operating expenses and debt payments. And the reason being, The reason being, I would say, is number one, or reasons to have this money is you've got a maturity. So you got a loan maturity in in 2 to 3 years from when you start. You've got a larger rehab budget, right? So on these bridge loans, most of those were like 7,500 to 15,000 a door, right? Rehabs. On
Mm-hmm.
these fixed rate, Fannie agency loans, usually the rehab's not that big. So you got larger rehab budget, you got loan maturity, you've got interest rate risk. So you got to buy another cap, and then what the big. So on this loan maturity, you might have to pay down the loan to refinance.
Cash in refi.
Cash in refi. So to me, I think this is this one is this is the lesson here is really around probably raising efficient equity front on the deal. All right. So that's not as pretty of a slide, but I think it's important to have, because I know a lot of people, a lot of syndicators that they'll quote unquote raise this much, right? 6 to 12 months of operating expenses on fixed rate deals, right? So they're even doubly safe in the
More conservative. Yeah.
Yeah. And the only reason that people don't do this, do you know why people don't do this?
Juice the returns.
Yeah, they're thinking, oh man, I'm going to have all this extra capital and I can't provide the return on it, but I'm trying to protect the principal on the deal. So
yeah, and some people only raise enough to close the deal, and then they try to raise after to get the cushion.
Sean, thanks for jumping on. I'll just change this. I need to change the slide to
the oh crap fund.
Oh crap fund. Sean, give us some examples of when you've had to use your fund. Yes, and I would say, yeah, the older the property, the more reserves you should have. So I'm gonna add that in there. So let's see, reserves. Yeah, we should probably. I mean, this is sort of this is what you were talking about. I wasn't clear on my question, but in replacement reserves, right? So replacement reserves on Class A are typically what, like 200, 250 a door?
Yeah, you're going to need to replace less refrigerators and less things on a Class A.
Yeah, 250 to 300.
Less ACs, maybe.
No, I think it's the same amount. I think it's just the big ticket items. Like on B and C stuff, you're having to deal with like the plumbing, the siding, all that type of stuff.
Yeah, Sean said you gotta love the 70s cast iron pipes.
Yeah, this is I mean, the quote that I heard from one person who owned some Class C in Houston out on a panel way back when, he said he had to hold through the recession. So the last recession started 2009, 10, 11, 2009 to 2012, Class C property in Houston. He said the real replacement reserve is 1,000 a unit per year.
It's not what the lender requires.
No. The lender requires this number, right?
Yeah.
But then he's saying after owning these properties for 3, 4, 5 years, especially after you've done the initial rehab, right? So you put 5,000 a door into the property, and then now you're just holding it, right? So you're surviving for the next couple of years. 2009 is not a great time to sell, so you're going to hold it. But the real replacement reserve is like 1,000 a door. So, all right. So plumbing leaks, 1970s, cast iron pipes. So yeah, you got to hold that. All right. So let's. I think that was less than 10. Did we miss anything? Put in the
I was
comments. I
I
haven't
was
been
seeing
monitoring
some
the comments.
comments, couple comments. What's going to happen with these syndicator careers on these defaults?
Okay, hold on. Let's get that. I'm gonna wrap. So lessons learned. Number one, interest rate cap on a floating rate loan. So buy the interest rate cap. I think you should buy it. Like, what strike do you think you should buy at? This is always an interesting question. So let's say it's your spread is SOFR plus 3 to do the math. Um, Probably cap it at what the fixed rate would be. Maybe buy like a 2.5 strike,
Yeah, try to
five
get
and a
some
half.
positive leverage if you can get a
Yeah,
5.5 cap deal.
yeah,
But the last live we did when we underwrote that $10 million deal, the 1% strike looked like a good return. I think
be good.
I think it depends on your underwriting, right? Like
Okay.
how it comes out in the model. But also, I don't think you should go out too far on term because if interest rates go down, those get cheaper, and it's kind of like a sunk cost if you buy it up front, right?
Are you talking about the strike rate? How many
Like
years
how
you have
many
to buy?
years? Like if you buy it
Okay.
for 2 years or if you buy it for 3 years. So if you buy it for 3 years, you're paying all that money up front, right? It's like a sunk cost almost. And so if you only buy it for 2 years and then you escrow for a third, and then the third years drops off a cliff and is significantly cheaper, then it might not make sense to buy it that far out at a high price today. That makes sense.
So it depends on where you are in the cycle, right?
Yeah.
So like today, uh, so Fannie and Freddie, they make you buy 3 years. Doesn't matter.
Yeah, that's
and
true.
most bridge lenders, they make you buy 3 years now as well. So whatever the term of the loan is, that's what you're gonna have to buy. So lesson learned: number one, buy an interest rate cap on a floating rate loan. Number two, keep your leverage low. I would say probably in the 70s or 60s, 65 to 70% leverage on a bridge loan. Number three, beware of pref equity. So above 80%, that's probably the max that you want to go. So if you have a bridge or Fannie Freddie loan at 50 to 60% and then do the pref up to another 10 to 15, you don't really want to go past 80. Number four, the asset management of these deals is key. So make sure you have someone sort of boots on the ground there. Number five, location. So, I mean, you can either look it up, right? So you can go, do a demographic study, or you can email us and ask us about a property. We can look it up and send you sort of what the, median household income, all that type of stuff is, and compare it to the rents. And then watch the speed of acquisitions, right? So a lot of people are trying to move sort of from their day job into this full time, and they might just buy a ton of deals to make a ton of money on acquisition fees. But watch the speed of acquisitions. Larger is not necessarily better on these deals in terms of size. Like, probably once you get past 300 units, I don't think 500 or 600 units is going to help that much. Communication is
But it,
key.
it sounds
Yeah.
good at a networking event and a conference, though, right?
I've got 10,000 units. I'm the king.
All right,
Uh,
you won the multifamily world.
yeah. So communication is key, especially from, like, to me, I think communication is huge right now, because especially as stuff gets worse or goes down, you need to be upfront with your investors about where they are in the process, versus just sort of going into a hole and not coming out. And then distributions are good generally, but you have to make sure that they're coming from the property, right? If they're not coming from the property, then no good, because they're probably coming from another source, like another property, to keep this thing afloat. And then capital calls early in a hold period is a red flag. So I would just say on this one, probably adequate, sufficient reserves raised upfront. All right. Any comments on those? What sort of the ones that stick out to you on that list?
from the comments section.
No. From the lessons learned, just sort of recapping the lessons learned.
I think just managing your growth and being conservative. I mean, definitely you need to take risks when you're. Everything's a risk when you're investing, right? But yeah, you don't need to be the fastest one to 10,000 units. I mean, after a certain amount, like most people don't really care that much, and then there's always going to be somebody bigger than you. So I think just going at your own pace and being conservative and making sure that you can stay in the game long term, because you're eventually going to get there. The longer you stay in the multifamily game, the further you go, right? You don't need to get there in a year, 2 years. I think it's a long term game.
Yeah, I mean, I think this is sort of like every time I go through a deal, I'm trying to think of, all right, what could blow this deal up, right? Where I put in 100,000 and the 100,000 does not come back to me, right?
Yeah.
So like each one of these things could be a flag, right? So if they're like, yep, it's a floating rate loan and we're not buying a cap, boom, red flag. Okay, I'm taking 80% bridge loan. That's another flag. All right, I'm doing pref equity on top of in front of your common equity. Okay, that's a flag. You got local, you got asset management. So where are you based? All right, I'm based in Dallas, but all these properties are in Houston. Do you own anything in Houston? No, I don't own anything in Houston. That's a flag. Where's this property located? Okay, yeah, we've got it's in the submarket. Okay, what's the median income? 30,000. Okay, that's a flag. Uh, how many deals have you bought in the last 8 months? I bought 10 properties in the last 8 months. Okay, that's a flag. How big is this property? 900 units. That's a
Yeah.
flag. And
Yeah,
then
because
this,
the bigger size is just it takes more to feed the deal. I
yeah,
think somebody that's well capitalized would rather invest in 150 to 250 unit on somebody that's really well capitalized, has a good plan versus swinging for the fences on 1,000 units.
yeah, and communication. I think that's so. And this is harder to do. Is talking to current limited partners about the general partner and seeing what their experience is. I'm pretty sure most of the LPs in these deals did not talk to previous LPs on these deals. I think they just assumed, okay, you bought a property and it was 100 units and you did well from 2018 to 2021. Great. Now, all right, you doubled my money. Now do it again, but now instead of 100 units in Wichita Falls, now it's 1,000 units in Houston. Like it's a pretty big jump up, and that was a $5 million deal, and now you're doing $100 million deal. So, yeah, scaling up quickly, and then distributions. Yeah, I think Sean Griffith jumping in, never pay distributions from your reserves, hold on to that stuff, and then making sure you have sufficient cash flow as well. And then, so Malai, so what I meant by this is usually the lender requires a certain amount of reserves. So let's say 250 to 300 a door. And then now, what so a lot of that is collected monthly on your statement. And what this operator was saying at this conference was there's a lot of below the line expenses on, let's say, B and C properties, probably more C properties, that in reality it is closer to 1,000. So let's say a 200 unit deal, so 1,000 a unit, 200 times 1,000, making sure I can do the math. It's that amount is going to be closer to $200,000 a year in terms of actual repairs and maintenance to the property. And so a lot of times repairs and maintenance shows up as, I don't know, 750 a door above the line, but then there's probably another 1,000 or 500 a unit below the line, if that makes any sense. So
CapEx.
yeah. Sean, you're killing me today. So we're gonna be like the referee throwing a flag as these guys are pitching deals, and every time something happens, we're gonna throw the flag on the field. Yes, that would be funny. Maybe we should add that to the next conference. So, um, all right, James, any other comments that you saw coming in? I think I tried to.
Yeah, I saw a couple.
Okay.
JG had one. What's gonna happen to these bridge lenders with all these leverage loans?
Okay. So when you did a bridge loan, you had the option as a lender to hold it on your balance sheet, or you could package it up in sort of a securitization and then sell it off to investors, and you held a piece. So you held a piece of that loan. And so some people are going to lose a little bit of money, and some people might lose a lot of money. And it all depends on when they foreclose on these properties. If they do foreclose, what happens, right? And so if you go back to um, this slide at the beginning. All right, if you go back to this slide, let me just hide this real quick. So the original loan, let's say, was 230, and then it sold for 196. So it sold. They essentially lost $32 million on the loan balance in terms of principal, and
Mhm.
so that was a small percentage, right? So they didn't lose the entire amount, right? So, but it's gonna, yeah. I mean, it's definitely depending, like the outcome on some of these deals might be that they sell it for a lot less than the loan balance, and they're gonna have to take a loss on these deals. So
And then another one we had was what's gonna happen with these syndicators that get foreclosed on? Is their career over, or are they coming back?
so I would say it depends on how you come back and what the story is, right? So this one is going to be pretty hard to come back from. Like when you're covered in the Wall Street Journal, I mean, every lender is going to Google your name, and so you might be coming back as sort of a silent partner. You might be coming back as a limited partner, and not necessarily as a general partner who are signing on loans, right? So, people sort of had a story 2008, 2009, 2010 that they just sort of got caught up in, and now 10 years later they're back, right? But you're definitely going to be on the bench for a little bit. I would say 3 to 5 years you're going to be on the bench, and you're going to be doing something else probably for a little bit.
Yeah, I don't think there's anybody in this industry that doesn't know this story.
Yeah, yeah.
Maybe, I don't know, but it seems like it was pretty widespread. Now we got another LinkedIn user. Given the lack of experience, fast ramp up, and other red flags, how did they obtain the loan?
So I think it goes back to sort of, you have to go back to the mentality in 2021. And what happens is you take out a loan and you put it in front of 20 lenders. And the first lender says, I'll do it for 70% leverage and a spread of 325 or 350 over SOFR. Let's say 350. And then another lender comes in and says, all right, you said 70%, I'll do 75%. Okay. And I'll do SOFR plus 325. Then the next lender comes in and says, I'll do 80% leverage, and then I'll do SOFR plus three. And then there's 3 or 4 guys who are all bidding on the deal. And now they say, well, my net worth's like $10 million. Okay, that's not a problem. We can work with that. So it's just it's a race to the bottom in terms of leverage, in terms of interest rate, in terms of underwriting strictness criteria, and so that is the challenge in lending, is you have to hold to your criteria. And one of the things, so and I'm not saying this is perfect, but what happens, and when I was at GE Capital, I remember I did a rotation in the credit card department, right? And in credit card department, they basically charge 20% interest. And if they already underwrite like a 4 to 5% delinquency. And so some lenders are willing to take the risk, right? So they know that there's going to be delinquency. They know that they're going to have to work some stuff out, but they charge an interest that is sufficient for the risk,
Yeah,
right?
because
And so
they're making a point on the loan, right? So that's $2 million that they just make just by issuing. That doesn't even count all the interest that they're going to make on the loan. And then kind of the zeitgeist of multifamily at the time was that it's not failing. You can't lose money in this business almost, right?
right. And so so what's going to happen is, and this is what happened sort of 08, 9, 10, 11, is that some of these lenders, they're going to foreclose, or they might sell the loan to somebody else. And they've sort of put sufficient reserves aside, right? And so, but in trying to answer this question without going too much on a tangent, is that because of the competition, because of the number of lenders, that is what drove their ability to get the loan at that point. All right. Any other questions out there?
I think that pretty much wraps it up.
Okay.
We're
All
at
right.
about an hour, so.
Any other questions? Put it in the chat. So I'll PDF this presentation. If you want the presentation, just email us and we'll give you the presentation or send you the presentation. And then any other questions, feel free to reach out to us. But definitely subscribe to the channel, like the video. That helps us. And any other questions, any ideas? Obviously, we read the comments and we'll take those ideas. So any ideas for future episodes, definitely let us know, and we will talk to you guys on the next live.
Oh yeah, and give a quick shout out for tomorrow's event that we have.
Yeah,
Series.
so if you go to, we'll put it here, let me put it in the chat real quick. See if I can find the link.
Try to save some of these foreclosures by doing capital calls.
Yeah, so we have a Zoom virtual meeting. So all the people who can't normally join us. So this is for tomorrow. Here's the registration. So this is Capital Calls 101. So we're going to be interviewing Neil Balwa about capital calls on this and sort of how to do them, right? Because it's almost like a new deal, new equity, and really going through it. And so so we'll put up the replay. It'll be on YouTube and LinkedIn, Dennis, with any questions. And then but yeah, check out the capital call thing tomorrow is at 6 to 9 Central, and it will be on Zoom, so we'll be able to see your face versus just comments. So appreciate everyone jumping on. If you have any questions or ideas, definitely reach out to us. And thank you for being here today.
All right. Thanks, everyone.
All right. See you guys.